Hello, welcome back to International Finance. This lecture is going to be on foreign direct investment and real options. So let's jump right in. Our last lessons, we've gone through the balance of payment and Brexit, international monetary system, corporate governance. We've gone through the agency problem. We've looked at foreign exchange and derivatives. We've identified different arbitrage opportunities. And the last topic that we covered was option strategies. We looked at various option strategies depending on your expectations, if you think prices will increase or decrease, and then also based on your hedging needs. We're going to take that same mechanism, that same way of identifying the correct option strategy and apply that to other investment decisions that are made by the firm. So as we get into the second part of the course and understand firm investment decisions and investor investment decisions, one of the largest ones that we'll encounter is going to be FDI, foreign direct investment. So this lecture, we're going to go through foreign direct investment. We're going to try to understand why firms engage in foreign direct investment. We'll look at some trends and a very recent case of political risk. And then we'll talk quite a bit about cross-border M&A and how these are very long-term investments. Think many, many years. If you're building a new facility, you plan to be someplace for quite some long time. So when we have these very long-term investments, oftentimes they're things that we just don't know. We don't know how the political system will evolve. We don't know how exchange rates will evolve. We don't know how local labor laws will evolve. So one of the things that we would like is some flexibility in our decision making. So we're going to use real option theory to understand managerial flexibility and to quantify. We want to put a number to whether or not we should wait or abandon a project and everything in between. So let's get right in. What is FDI? Earlier, when we went through the balance of payments, we talked quite an extensive bit about the international monetary system and capital flows. So I know you're very familiar and very comfortable with foreign direct investment. Just as a light refresher, the main idea is that we're looking at transactions that are going to exchange control of a business or a production facility. So that could include a greenfield investment, which is when a firm builds a brand new facility or some sort of brand new operations that are established in a country. That can also include cross-border mergers and acquisitions. That's when we go and buy an established firm. And part of the reason why you would want to buy an established firm as opposed to building brand new facilities is that the established firm has a supply chain, has market share, has connections, has know-how. So it all kind of depends on what your objective is from the perspective of the financial manager. And then we also have investors making controlling stakes in companies. And again, our rule of thumb, if you've got 10+% of the company, we'll think of you as a controlling shareholder, or you have a controlling stake in the firm. Some more terminology. We have FDI flows, which are going to represent additions to the existing stock of FDI. So the flows are going to be our yearly flow of capital, our yearly flow of these large flows between countries. The stocks, FDI stocks, are the accumulation of previous FDI flows. So you can think of this as, let's say the multinational corporation has facilities and operations, plants all around the world. Not every single year is the firm going to be acquiring another firm or building a brand new facility. So we still want a way of keeping track of the previous flow of capital. And again, these are really, really large volumes. A few more terms of terminology. I know you're very familiar with multinational corporation, MNC. Main idea is that the firm has a country in which it's headquartered or primarily domiciled, and that's distinct from the host country, which is the country in which the foreign firm operates. And that could be, again, facilities, operations, plants, sourcing, etc. Many multinationals will try to establish operations in a host country that has natural resources to reduce transportation costs. Or you may choose to open a facility in a host country as opposed to agreeing to a licensing deal because you want to protect a trade secret. A great example of this is Coca-Cola. In the 1960s, Coca-Cola was heavily involved in opening up new facilities all around the world. One of those places was India. And in India, eventually, Coke was told either you share the secret or you got to go. And Coca-Cola decided to leave. So the big point is that we have all these different types of FDI. We've got these greenfield investments, we've got cross-border M&A, and these are really large capital flows. So let's get a sense of the size. FDI stocks, again, are the accumulation of these previous FDI flows. And the FDI stocks themselves have increased by roughly 6,000% over the last 30 years. So FDI stocks totaled in 1980, a little bit over 500 billion. 2017, we're talking well over 31 trillion. So quite a large amount of FDI is held all around the world. When we look at where that FDI goes, so if we look at the outflows and inflows, primarily it's actually a lot of it is going to be from developed countries to other developed countries, but there's still quite a bit of cross-sectional variation around the world in who receives it and who sends it out. One of the things that's striking when you just take a look at this figure is you can see that there are a handful of nations that have relatively comparable amounts of outward FDI. So this is investors and firms within that home country acquiring or creating greenfield investments in other countries, or they have a lot of inward FDI, inward flows. But what's so surprising is that you do have plenty of countries that are really, really high on outflow or are really high on inflow. So some of that variation across countries is of course, interesting and would suggest that there are different frictions and different barriers and different opportunities that are affecting these decisions. So where is it held? If we look at where the FDI stock, the accumulation of this FDI, where a lot of it's held, one of the biggest countries that you'll see on this chart is the US. The US is a massive host of the world's FDI. And it's not just the US, we also have China, the UK, Germany, so lots of different countries around the world are hosts of this foreign direct investment. Why would firms do this? Why do firms invest overseas? The answer is almost always going to be market frictions or some kind of investment opportunities. And those two tend to run hand in hand. We have very understandable economic frictions, trade barriers, and labor market imperfections, which we'll get into. Then we also have legal and rule of law and enforcement frictions. And one of those that's going to be very important is with intangible assets. You can imagine that if you are the financial manager of a firm that has a ton of IP, a ton of intellectual property, you've got the opportunity to license that intellectual property, but depending on the nature of it, you may want to hold on to those trade secrets, or you may worry that your intellectual property won't be respected if you're operating in a host country that has weak enforcement or weak patent protections. So this isn't a thing that sometimes we think of as first order, but it's incredibly important. When you look at the countries that host a ton of the world's FDI, you'll also see that it's sometimes by industry, because there'll be, again, different ways that certain industries are protected or are have legal recourse depending on the code of law for the country. So it's very interesting. Obviously, there's efficiency and cost cutting and vertical integration. We're not going to spend much time on that in this lecture. I'm sure you've heard over and over that companies are going overseas to lower cost and lower costs. So I think that's something that's probably very intuitive. The last thing that you may not have heard of are operational synergies and financing frictions. And what's the idea here? With an operational synergy, essentially, 1 + 1 = 3 is the way to think about it. Firm A joins with firm B, and combined, they're able to create more value than would be if either of these firms were to maintain standalone. The financing constraints are a similar story. Let's say that firm A has great investment opportunities, but has a lot of leverage. So much so that firm A's value is actually falling because firm A is over levered. Let's say that you really worry that firm A is going to go bankrupt. Firm B, that can be well capitalized, can come and acquire firm A and actually take advantage of those investment opportunities. And now everybody's better off. Why? Because you've relieved those financing constraints. I don't have to worry as a shareholder that there are all kinds of states of the world where the manager might take on bad investment opportunities or skip investment opportunities. So we're all better off. Okay, trade barriers. How can trade barriers affect the firm? Well, obviously we have tariffs and quotas and other restrictions on the free flow of goods, services, and people. We looked at this quite a bit when we talked about Brexit and how with Brexit, you actually see this return of all these trade barriers between the UK and the EU. The trade barriers don't always have to be legal enforcements or legal quotas or tariffs. They can also happen naturally. For example, high transportation costs is such a significant barrier to trade, especially for low value to weight goods. What do I mean when I say low value to weight? I mean, think about something like cement or mineral ore or lots of other resources where the transportation costs can often be higher than the profit margins that you would encounter using them as a means of production. What does that mean? It means if it costs more for me to ship it than to use it, I probably will want to locate myself close to this resource just so I don't have to spend so much in transportation. So I can actually get a finished good, get a product, get it to a next stage of production. How can FDI allow the firm around trade barriers? So this is interesting. If you're producing goods in the foreign market, you essentially can use FDI to become local. You can have a greenfield investment where you build a new local facility, or you can acquire an established firm, an established business or enterprise that's already operating in that market. So this is sometimes a way to circumvent tariffs and quotas and et cetera. And accessing large trading blocks and taking advantage of segmented markets is another way that FDI can allow the firm around trade barriers. For example, we talked about this when we were looking at Brexit, how there were a number of firms, financial service firms, and many other firms that located production in the UK to take advantage of access to the EU, and how once Brexit went through, they lost that comparative advantage. They lost that access to a large trading bloc. The same thing has happened within the States. A great example of this is in Ohio. Honda and a number of other international automakers have located production facilities all across the US. In many cases, these were in response to waves of trade barriers and waves of trade quotas that caused a lot of the Korean and Japanese and German automakers to try to figure out a way around. And it's the same story. You become local, you produce the automobiles locally within the country. Now you're very much a local firm for a lot of perspectives. So the big idea is that we're looking at ways of dealing with these trade barriers. And to be clear, whenever there are these barriers, there will be winners and there will be losers, but it may not always happen the way that we think. Sometimes there can be spillovers to other markets. For example, Mexico. Very recently, we've had a large trade war between the US and China that has caused all sorts of disruptions to global supply and to business as usual. An investment bank, Nomura, picked Mexico as the US trade war winner from outside of Asia. And here's the argument. The investment bank noted how within about a year's time span, almost maybe less than a year, within about a year's time span, there's a range of sectors that have had new facilities open up in Mexico. Everything from electrical equipment to auto to component parts, etc. And the argument that's made in the article from the investment bank is essentially that Mexico enjoys really close proximity to the US, relatively minor cultural gap between the US and Mexico. You've lots of improvements in infrastructure to basically make it a lot easier to ship and source goods within the country. And then you have a high degree of integration with the US and with this large trading bloc. What does all that suggest? It suggests that trade, shipping costs, culture, all of these things are incredibly important when we're talking about a long-term investment like FDI. So we have trade barriers, we have quotas, we have tariffs, we have things that restrict the ability to move goods between countries. And a way of addressing those restrictions is by acquiring a company that's in that country or by opening up production within that country as a way of basically alleviating some of these trade barriers. We also have massive labor market imperfections. Labor markets are far from globally integrated. We have HR and we have human resource and legal requirements all around the world, very country specific. So there are restrictions on when workers can be fired, what their severance payments will look like. What's the proper cause for termination? How long do I have to be basically on watch before you can let me go? There are all types of differences across countries. We also have very real frictions on the flow of workers across borders. Again, when we talked about Brexit, we said that one of the major disruptions is that now you've got a whole team, masses of people that have work visas that are in limbo, and all of that is very disruptive. We have differences in educational institutions and cultural institutions around the world that can make finding local workers in certain industries in certain countries very difficult. Because these labor markets are not globally integrated, and again, as we've been saying over and over throughout the course, because you have these very real frictions and very real barriers to the flow of workers across borders, if you are a firm, how do you deal with this? How do you circumvent these labor market imperfections? And the answer is fairly simple. You move to where the workers are located. And if that is a concept that is a little bit difficult to wrap your head around, the same thing happens domestically all the time. If you look within the states, you have clusters of industries. And the argument behind these industry clusters is that if I've got a ton of people that are software engineers, then it's very easy for me to open up a new tech company. Why? Because if I'm in San Francisco, or if I'm in Boston, if I'm in New York, if I'm in one of these cities that has a mass of software engineers, it's very easy for me to find people to work with to help me grow the firm. It's not a cost that I have to incur to go and find really, really good and well-qualified individuals to work in this industry. So you see a ton of high-tech FDI with foreign firms acquiring US high-tech companies for largely the same idea, because you want access to all of these software engineers or all of these app developers who are here. So when workers are not mobile because of immigration barriers, cultural barriers, all sorts of restrictions that prevent the free flow of people and make it very difficult if you're trying to operate a business in a certain industry in a certain location, the firms that are able to can move to where the workers are to benefit from these underpriced labor services. What's the effect? Well, these imperfections in the labor market are going to lead to persistent wage differentials across countries. And hopefully that makes intuitive sense. If I'm not able, or if there are restrictions, implicit or explicit, that make it very difficult for me to relocate myself to where an opportunity to be employed or an opportunity to use my skill sets is, then I'm not going to be priced against those workers. If that sounds too abstract, we're here in New York. Now that everything has gone virtual, you can find jobs all across the country. But for many a year, a big question from a recruiter or a big question from a firm would be basically, are you willing to relocate to our city? Are you willing to relocate to where we are if we hire you? And it's the same idea. If you have all of these barriers within the labor market, you're not going to have wages for these different industries and for these different productivities sort of sync up. You're going to see persistent wage differentials across countries. If there are frictions, then these labor services can be underpriced in some markets and overpriced in others. And what does over and underpriced mean as we're describing labor market imperfections? Really, what we're saying is that the labor costs might be higher than the productivity, or the opposite could be true. The labor costs could be low relative to the high productivity. So that's sort of the idea. When we have these barriers, we have this wedge between the market price and the productive return for that ability. And it's going to be persistent because they're not going to be resolved very easily. Another key factor behind FDI are intangible assets. So what makes intangible assets different? And intangible assets, again, you can think about intellectual property. These are assets that we can value off the balance sheet, but it can be really, really difficult for us to try to package them. So it may never show up on our balance sheet, but there's certainly going to be intellectual property. There's certainly going to be trade secrets. There's certainly going to be corporate strategy. There's going to be all types of occupational, firm-specific, and industry-specific knowledge and intangible property that will affect firm value. A great example is Coca-Cola's secret formula. What's important here? Well, corporate governance is incredibly important. If you're telling me that we have trade secrets or corporate strategy that we really want to protect, but I'm operating in a host country that has weak rule of law or a lack of enforcement of property rights or a lack of enforcement of contracts, then those intangible assets can very easily be exploited. And when I say exploited, I don't mean by the firm that has them, but I mean by a competitor or yeah, basically just that a competitor can get their hands on your trade secrets, and then you're kind of, you're out of luck. Since intangible assets are often difficult to package and sell, multinationals can enjoy a comparative advantage with FDI. What does that mean? It means that if it's really tough for me to write down on a sheet of paper what it is that is our intellectual property, or what's our corporate strategy, or what's the thing that makes our firm so valuable, it might be really difficult to package and to sell that. And because of that, I might be even more inclined to make a greenfield investment or to acquire another firm and bring this intangible asset that we have with us. Or I might acquire the other firm to get access to the intangible assets, the proprietary assets that they have. What's important here? A big theory that we use to try to understand why firms would want to protect their intangible assets, it's called internalization theory. And it predicts that companies with intangible assets that have these public good qualities are going to invest directly in foreign countries. A public good quality, a public good is basically something that we can all consume, but it's really hard for me to restrict your consumption of it. So let's say that I have a ton of R&D. I'm our company's trying to innovate. So we've got a lot of intellectual property, and our worry is that once that intellectual property becomes known to the public, it'll be very easy for firms and competitors and everyone else to basically reverse engineer our process. So we're not at the stage of filing for a patent, but we're engaged in all of this R&D. And I worry that if I just have a licensing deal, or if I operate in a market with weak contract protections, that it'll be very easy for this intellectual property, our trade secret, our patent, our corporate strategy to become publicly known. So what do? Well, internalization theory is going to predict that instead of agreeing to a licensing deal or an arm's length contract, you just go directly to the foreign market and you operate. So this would allow them to use these assets and to avoid the intangible asset being misappropriated while transacting in the foreign market. Thus, the rule of law or the property rights are important. If you protect the intellectual property, I'm much more inclined to come and bring it with me to set up operations. A major friction to foreign direct investment is political risk. And the way that oftentimes this is categorized and thought of, it's usually within the context of operating within a developing market. That's oftentimes the way that you'll see this packaged. But political risk is by no means restricted to emerging economies. Political risk, really, this is the potential loss to the firm resulting from adverse political developments in the host country. So we worry, when I say we, I mean the corporation, you as a financial manager, you worry that something politically could evolve that's going to affect the firm. This could involve transfer risk. So political risk can, depending on its form, can kind of come into these three different brackets. One is transfer risk. And a really easy way to understand that is you put barriers on my ability to get the capital out of the country. So you could say that there's a new moratorium on dividends, or there's new capital controls, or if the country is really worried about there being speculative capital flows, they can say, look, we're gonna put a barrier on our capital market for the next quarter. Well, obviously, if I can't get the capital out of the country, then I'm kind of stuck there. There's operational risk. Here, you worry that the host country is going to adopt policies that impact local operations. So this could be unexpected environmental policies. This could be changes in labor laws. This could be a new local sourcing requirement. Anything that's unexpected, that's going to affect you operationally. And the last form of political risk that we kind of think of is control risk. In here, you really worry that there's going to be some change or some policy change for ownership or control of local operations. So sometimes countries will say you have to have a fade out, meaning over the next 5 years, there needs to be some exit plan in which you build this facility and then you sell it or you transfer control to local firms. The same thing happens with nationalization of an industry. There can be a sector of the economy that's now deemed politically important, or for security reasons is deemed important, that now, because of that classification, you basically have restrictions on foreign ownership. So control risk, operational risk, transfer risk, these are very real political risks that are by no means restricted to developing and emerging markets. This is all around the world. And part of the reason why FDI is oftentimes politically triggering is because, again, we're talking about having a controlling stake of a business or a control of operations in a different country. So let's look a bit more at cross-border M&A. M&A represents mergers and acquisitions, represent well over 50% of these FDI flows. And what forms do these take? So really, these cross-border acquisitions can be purchasing an existing business. So you buy a firm. It could be a private firm, meaning that it's not publicly listed. You could be an acquirer for a public firm. That means that you're listed on an exchange. So they can take different forms. But really, you're trying to get access to a market. You're trying to get access to a market share, a supply chain, a pool of talent, a corporate strategy, all the things that we said that would affect FDI, you may also try to acquire through a merger or acquisition. And this is very distinct from greenfield investments in which you're building new facilities from the ground up. Cross-border acquisitions are incredibly politically sensitive. Greenfield investments are usually welcome. Very rarely is a country or a political system going to tell you, please don't come build new facilities here and potentially employ people that are located here. Cross-border acquisitions can be unwelcomed. And a great example of this is TikTok. Again, there was a massive amount of political risk surrounding the Chinese ownership of TikTok and whether or not they were going to be forced to basically sell to a U.S. partner. So that political risk, it eventually subsided. The episode passed, but it's very telling of how different sectors of the economy will sometimes be classified or reclassified as economically important or strategically important. And that can put a big barrier sometimes on cross-border